What's up YouTube? It's Taylor here and you're watching the Tailored Effect YouTube channel. Today I'm here to share with you some riveting information about life insurance. So we all know that life insurance is used typically when you die, so it should be called death insurance. But of course, as we know, that's not a very sexy term. That's not really great with marketing. So we call it life insurance. Now, before I get into the details of the video, I would please ask you to subscribe, to like this video, and to comment down below what your favorite type of life insurance is, or if you have any questions in general about this life insurance. Okay, so what I wanted to talk to you about was a few different types of insurance, the favorite ways that I like to explain life insurance, and then also add in and sprinkle in some lovely little key terms for you to be aware of if and when you are shopping for life insurance. Now, most people think that you use life insurance when you pass away, but there are ways that you can use life insurance as investment vehicles for you to use while you are alive. So with that, I'm going to dive into the two different types of insurance and be able to share with you exactly how each are used in different situations. So the easiest way that I can explain this is you have term policies and you have permanent policies. Now, term policies are similar to like renting an apartment, and those permanent policies are like buying a house. Stick with me here. When you rent an apartment, you get that specific apartment for 1 year. During that 1 year, the dollar amount, the rent is the same, the square footage, you get typically a little bit bigger square footage, and after that year is up, you then have to either get kicked out, find a different apartment, or pay a little bit higher rent for that apartment. Now, it is more affordable than purchasing a house, and there's a few other things that are really low maintenance about term policies. Now, on the other hand, you have the permanent policies, which inside of permanent policies, there are lots of different subtypes of life insurance. Like we've got whole life, we've got universal life, and a few other things like that. But what I really want to drive home is that you are buying a house. Now, the dollar amount is typically like 5 times more expensive on a permanent policy like a whole life plan than it is on the term plan. But you get to keep that for your whole life. The premiums do not change. The dollar amount stays the same. The death benefit, all of that stuff is locked in at the age you are at the time that you purchase the life insurance policy. So there's a couple different reasons. So you keep the house, you buy the house, it's an investment, and then what happens is that it actually accumulates cash value over time, just like you would have equity in a house. Of course, it's gonna cost more, you got a little bit more maintenance, a little bit more confusing than a lease or a term policy. So that is the two types of life insurance policies that you can see on any given day. Now, the reason that I'm talking to you about this is because this is what I do every single day. So in my insurance company, I help companies, specifically companies and group policies, put together really robust employee benefit packages. And a lot of times life insurance is included in that. And it is my job and my honor to be able to educate and show people how it is that we use life insurance, what we use it for, how it's important, and different ways to understand it. So that's exactly where I give this example on renting versus buying, renting an apartment versus buying a house. So that is just the simplest way that I've found to explain these policies and make it be an understandable thing for people. Now, when we talk about the death benefit is literally the dollar amount that's paid out when the insured passes away. So if you have a $100,000 policy, that means that when that person passes away, the beneficiary would then receive the $100,000 as their benefit. Now, we do, like I said, I do this for employee benefits. A lot of these benefits are mostly payroll deducted, which means that they're taking money out of every single check to receive this benefit, typically at like a group rate. And of course, those are post-tax premiums being paid, which means you don't have to pay premium, you don't have to pay taxes on it when the death benefit is paid out. Now, that's not super important, but what is super important is that you understand how and why life insurance can help you in life and in death. Like it's like doubly great. Now, I mentioned with the cash accumulating, the permanent policies, that there's a couple different like types of plans. We have a whole life policy and a universal life policy. Now there's different variations of each of these, but to kind of understand this completely, your universal life has a little bit more flexibility when it comes to paying in premiums. So if you wanted to pay $700 a month one month, $500 the next month, whatever, the dollar amount can fluctuate, and those difference of the dollar amount would come out of your death benefit. So if you paid $500 the next month, and then the next month and the next month, the dollar amount, if you passed away without paying up those dollars back to the plan, it would be the death benefit minus the premium that should have been collected, basically. So with that, you're looking at some more flexibility. You're also looking at, with both policies, the ability to over cash stimulate the plan. Now, this is the really, really interesting part, because of researching and finding out more information about these different types of policies. I've actually found out that the very, very wealthy people, the very, very wealthy families in this great nation of the United States, as well as the banking systems in our world, own billions, hundreds of billions of dollars worth of cash accumulating life insurance policies. Now, if that doesn't bring some bells in your brain and like, okay, maybe I should start waking up to see what else is out there, this is the sign that you need to be listening to, because this is a really, really big deal. Now, what they do is they're overfunding, they're over cash stimulating these policies to make sure that they are growing and growing and growing with tax deferred dollars. Also with that, when you're using a permanent policy, you're actually using the cash value to accumulate and grow with being tied to the market. So like an indexed universal life, an IUL, those specific policies are tied to the S&P 500. Now there are minimums to that of, if the S&P is down, 700% or whatever, your money won't go below the threshold of like 0%. And also the opposite of that as well, if it's over 15% or, whatever the threshold is for that specific policy, your plan won't earn more than that. So you get to use the juices of the market to beef up your life insurance policy. So what would happen is that over time, your policy would continue to grow and grow and grow, as well as the cash value grow and grow and grow. Now, what I mentioned earlier was that very wealthy families in the United States, well, probably and all around the world, as well as banking systems, they use this and fund their policies so that they can then borrow against their plans. Now, I'll make a more in-depth video later, but I wanted to give you just a preview of what this could potentially mean. If you have $100,000 worth of cash inside of let's just say an IUL, an indexed universal life plan, you can then borrow money against that. So you could literally write yourself a check for $50,000 to go buy a vehicle, whatever that would be, right? Your life insurance would still grow at the rate of $100,000, regardless of if you just pulled out $50K, which is crazy, because now you can use the dollars that are in your life insurance policy to help fund any additional investment. And now your money makes money on your money making money. And that is the craziest part about all this, is the mind-blowing system that is here and is ready for us once you open your eyes and start asking questions. So it's crazy. It can go down a real big old rabbit hole, but to know, just for you and I to know, for a normal person living their life, you can use that as your own banking system. Now, you might have heard this before as like an infinite banking or family banking, or whatever you want to call it. This is one of the things that the Rockefellers did and still do to this day. They take out these cash accumulating life insurance policies, they use them to fund and to make sure that their dollars are protected inside of these policies. And now you have created a banking system where you can then borrow against yourself, instead of paying the banks and the credit unions these dollars back in interest. You can actually just pay it back to yourself, back into the policy. So if you're regularly renting, you're buying a car and you're renting money for 3% from a bank, you could pay the bank that 3%, or you could just pay your policy back plus the interest that you would have paid with the bank note. So you can kind of see where you start to get into the churning, right, of the money making money. And that is exactly what I wanted to share with you, is that it is possible that this can happen to you. Now, you don't need to go in and put down $60,000 into a policy if you don't have that. But what you can do is start putting money aside every single month. Now, when you put the premiums into a cash accumulating life insurance policy, part of those dollars go towards the actual death benefit. So it's an actual insurance cost that is associated with it. The other dollar amounts that you have, those are going towards the cash value. Now, again, I didn't want to get too complicated and too much into the weeds with this, but when you're looking at receiving a life insurance policy, they're going to give you an actual policy details with a ledger and the annual year guaranteed rate of return and also the expected rate of return for some of these more specific policies. So they might guarantee a 4% annual rate of return, but they have historically maybe seen closer to 7% or 8% or whatever that percentage is. They're going to share with you all of those dollar amounts so that you can see and project exactly how much money you're going to be putting in, how much money you're going to be getting out, and how much money that money is going to be growing. So it's kind of crazy how detailed and how insane some of these plans can get. But when you consider that you can get a life insurance policy, one of these plans for maybe a young child or somebody who's just about to graduate high school, these plans can grow in an insane amount over the longevity of a lifespan, right? So when you're looking at these plans versus a term policy, you might get a term policy for, 10 years, 15 years, 30 years, something like that. But at the end of those 30 years, if you didn't pass away within that time frame, you don't get any of the premium back and you also don't get the death benefit. Unless you then pay up, just like on the rent in an apartment, that example I shared earlier, that would be when you'd get those dollars back, is if you paid up and then you passed away while that term was currently in force. So I know it's kind of insane, but those are the two types of main life insurance policies that you'll see. There's also another plan that you can look into. It's called like a final expense life insurance benefit, where it's just basically a set dollar amount where if you passed away, your beneficiaries would receive $10,000 or $15,000 for your funeral expenses. Those dollars can be paid directly to a funeral home, of your choice, whatever. It is really more of a planning move that you could use. Obviously, since the face value, the death benefit is lower, you're going to look at paying lower premiums. But of course, those are also based on age, health, tobacco use, some of those things. Another term that I wanted to share with you is guaranteed issue, right? So guaranteed issue, underwriting, medical exam, questionnaire, like all these words are kind of terrifying. And they are terrifying because they're basically ways that the insurance companies are weeding out people who are, maybe not weeding out is not the right word, but they are essentially putting up additional hurdles for people who are not as healthy. Now, if you were the life insurance company, you would want to say, hey, we want to insure really healthy people, really young people, and we're willing to give them a discount, quote unquote, a discount for being younger and more healthy. Whereas if you are a older person who is a tobacco user who's got a long history of, medical issues and things like that, your odds are more likely that the life insurance will pay out to you of that death benefit versus if you were a younger, healthy person, right? So it's just all about statistics when you're looking at it from the perspective of the life insurance carrier. Of course, guaranteed issue means that there's no health questions being asked. There's no additional information you need to provide. And that is one of the great things that I love about doing group policies, is that you have the ability to do a guaranteed issue for every person in the group. And that means that everybody is covered no matter what. Of course, there are other options where you can buy up, and those would mean that you'd have to answer some underwriting questions. Okay, what is underwriting? Underwriting is basically just, again, that way of fielding people to see the healthier versus non-healthy versus people who are uninsurable versus people who are, and so on and so forth. So again, they're just like statistically checking you out to see the probability of you passing away sooner rather than later, and that whole bit. So it makes sense from a business perspective, but from your perspective, you're probably like, well, that's baloney, that's really baloney. I don't want to have to pay more because I'm older. And I get it, I really do. But when you're looking at it from the, like I said, the life insurance company's perspective, that's exactly what they go off of. So that is what guaranteed issue means, is you get in with no questions. You get to get the policy, again, usually at a lower face value. Underwriting has questions you have to answer. And of course, like I said, a few other things that I just mentioned with the terms. But when you are looking at life insurance and you're considering buying life insurance for you or a loved one, please send me a DM on Instagram. I'd love to be able to help you walk through this process and share with you the the best ways to do it, because there are better ways than other based on your lifetime, your goals, your family's needs, your budget, and a lot of other things that come into play. So if you have questions, please send me a DM. I'd love to be able to answer questions for you. I can also pull quotes for you if you're looking. And just so you know too, this is not financial advice. This is not tax advice. This is simply my opinion and my stories of being in this industry for the last 5+ years. And if you do have any questions, please comment down below. Other than that, I will see you on the next video very soon. Go get yourself some life insurance.